Welcome back to the Opportunistic Trader. I am joined, lucky enough to be joined today by Mark Fisher, who I've known for over 30 years, is one of my trading idols. Watched him trade from the time I was in my young 20s all the way through now, and I'm pleased to have him with me. Welcome.
Hello, Larry. Why are you being so formal? We don't need to be that formal. Anyway, what's up?
Oh, all is good. I first wanted to start out by getting your thoughts on the broad spectrum of markets here. From anything that you're looking at across the board, just seeing what your thoughts are, and then I will share my thoughts and see if you have any opinions on what I'm thinking.
Okay, again, the stock market doesn't care about anything until it cares about something. So again, I don't think you can really, I think people, believe it or not, are underinvested. I think there's a lot of money that's just, doesn't know where to go. They're waiting for the rate hike in bonds. The rate hike hasn't come yet. They're sitting on the sidelines because they don't want to buy multiples like this in the stock, even though I don't think they're that bad. All the Trump nonsense. No one cares until they care. So again, like I told last time we were on the phone with Mike, until the market's down substantially, at 2:00 in the afternoon on some day with no bounce, down, 4, 5, 6, 8%, who's going to, these people aren't getting out. There's no reason. That's the first thing. Second thing is, I think that all the spreads in like I said before, the backwardation, the way that, it should be bought in energies, in RBOB, heating oil, crude oil, even natural gas. I think the risk is to the upside in all those commodities. I don't really understand what the whole thing was with Saudi Arabia and Aramco. I don't think they really understand what's with Saudi Arabia and Aramco. I don't know if they're going to sell it, if they're not going to sell it, if they're going to do a JV with China. I don't really know. I don't understand. But the perception that that Saudi was and it was going ahead and marking up oil in preparation for the IPO, I think that's all nonsense. I think demand is really tight everywhere, and I think that I think that it's a demand story in at least in energy. I also think this thing in Hawaii, I don't know what that's going to happen there, but that's an interesting thing, to see what goes on over there for the West Coast gas. I don't really know what's going to happen there because that's, Hawaii typically has 5 days of food supply and 4 days of energy supply on the island. And God forbid that, I don't know what's going to happen there.
Has there been a disruption, or they're talking about it?
Yeah, there's a hurricane, 4+ hurricane heading right there. So I don't know what's going to happen. Hopefully they'll miss it.
Yeah, hopefully it doesn't take Maui out. That's where I like to go.
But natural gas, of course, had a so-so inventory number of the market, but the market doesn't want to go down there either because everyone's short there. Gold, like I said before, I don't know who's selling the gold, but it's not going to until Venezuela's out. That I don't think gold can really rally at all.
I had a couple of questions on nat gas. I don't really trade nat gas at all, but I think it was before the '08 crisis or right around there, maybe '06, '07. I mean, nat gas was probably one of the best things, for a trader to trade as far as movement. It's it almost reminds me of a way of like how Bitcoin trades. You're getting, a small move in a Bitcoin is, 7 to 10%, and nat gas, went from 3 to, I don't know what the highs were, maybe 15 or 16 on spot. What do you think happened there that it's just been so dead for so many years?
I think that you have a tremendous amount of production, and every time natural gas picks its head up, that production comes in, it head all the money that's in there, private equity money goes into hedge. They make all their producers hedge out their inventory, and there hasn't been a reason to go ahead and be long natural. And so basically the producers come in every time natural gas gets delivered, where they can just justify their cash flow, so they sell it at $3, give or take. And until there's a disruption, in terms of weather, they're just going to keep selling till the cows come home. I mean, really, the natural gas, and I had this conversation, I don't know, 1 time, 2 times ago with you guys. is going to be a situation that when it goes, you're not going to want to be long anything but the spot month, because any disruption in natural gas is only going to be for a month or two. And so that basically you could have a situation occur where you know Jan, Feb, March, April, something like that. You can have something like one of those spreads go to a buck and a half, $2 even. But again, further out, the producers are just going to keep selling because there's so much production, and everyone's forcing them to sell in order to get financing to drill. So natural gas went from being, how should I say it, the no limit table of trading to now being,
the low limit. Now it's the low limit table. No, but I was just thinking about it because I remember I had a funny story. I was trading it a bit back in that period of time, and I had my hedge fund, and I wasn't trading size in any way, but I remember I had sold a lot. I don't remember what the size was. Maybe it was 100 or 50, and I remember this is before you could get markets on your phone and everything like that, and I had sold it. I was on the way to work, and I wasn't watching the market, but my office was, and I think I might have sold it at 11 or 11.50, and I said, if it gets to 12.50, give me a call. Literally, hang the phone up. My clerk says it's 12.50. I'm like, okay, you know what? I'm having a good month. I'm going to stay in it, whatever. I said, if it gets to 13.50, give me a call. Hang the phone up. It's like 13.50. But 10 minutes later, it was back to 10.50. So the movement was moving 20% every whatever. And I'm just trying to understand what that was.
But that's actually an interesting thing, because what usually happens is parabolic moves and then parabolic corrections, right? So when you were short nat gas for no reason, just other than you might probably just want to fade it, not knowing anything, right? Mm-hmm. You went ahead and you were selling into a parabolic move, and lucky enough you were able to hold on, and the thing came off. That's why, everybody, including me, every day, everybody comes in, okay, this is the top of the stock market, right? Trump, this, that. But yet there really isn't a parabolic move in the stock market, is there?
No, it's very different. The equities are, the way I look at equities is they're almost contrived. And, if we did have that parabolic move, or we did have that 2% move, which probably would hurt, people that obviously a lot of short players, would have to throw the towel in, but it would change the complexion of the volatility in the market. And the market is okay with a 12 volatility because they're contained moves. I always say, and you saw it a little bit in February, and you and I both know this because, you know what happened in February off the volatility. Literally, clearing firms were shutting people down from making opening transactions in index options because of what was going on with put pricing and the fact that everyone was short puts. And really, if that move lasted, which they never do, the implications would have been significant. But basically, all the clearing firms got their customers out, got in line, and never had an issue. So, my thought is for the market and the hedge funds, this is perfect. If they go up 6, 7, 10 a day, 20, 30 basis points, the next thing you look up, we're up 7. But, and we haven't had it, but could you just imagine, what do you think would happen if we had a down 2% day followed by a down 3% day? What do you think would happen in the market?
Then you finally get volatile. Then you probably, that's what you got to wait for it to have enough power left to be able to trade when that happens. It's going to happen. It doesn't matter when. I don't know when.
Yeah, for sure. But I think it's, looking at it, it's not even the one down day. It's the one down day followed by the second, which really is the reason why volatility hasn't spiked significantly. But like in the last 2 weeks, we've had one down day of almost 1% on the opening, which we didn't settle down there. And volatility went from 12 to 15 and 16 off of a 1% move. So
the thing I don't understand about this whole thing is, it makes me not cautious, but not concerned. I don't even know the word, it's just puzzled. Is if you look at all these private equity valuations of all these companies in the private market, they are so much higher than the public markets. And yet, and most of these companies are losing money, and yet they're attracting gazillions of dollars, and so there's such a spread between the public and private market that to some degree the public market is the cheap market. Like look at Uber. They just hired a new CFO, right? Who comes out of the New York Stock Exchange, right? right? They're losing money every month, and yet again, their valuation is some crazy number. All these companies are crazy numbers,
Right.
right?
Well, it's funny that you mentioned that. They had a big PE player on this morning on CNBC. I forgot who it was, but someone, that's been doing it since the 70s and 80s. And basically he said, they're doing deals, but the value of the deals that they're doing are so skewed with not near enough in it. Like they might have had, potentially 30-40% in there doing deals for 10s and 15s because they have money, they have to put it to work, and prices are high. So I think you're kind of right. I mean, maybe some of these equities, even though the valuations are now up in the close to the trillions, and Apple is in the trillions, that maybe it might be better than buying an Uber at 400 million or whatever. So that's an interesting thought. So again, there's probably a ton of money out there, and it's looking for a place to go.
Right.
One thing I wanted to talk about, and it's something that I think about all the time, and is important to trading and traders, and you've seen it because you've managed hundreds, if not thousands, of traders, and I've managed a lot of traders, and talking about the transition that we've seen over the years from the floor to the screen, making that transition, and then being a screen trader and making the trading screen change to understanding the algos and how that works and how that's changed. And I just wanted to know your thoughts on that, and I would talk about my opinion as well.
I think it's simple. I think if you're a trader today, if you're a click trader, right? Really, your job is not trading. Your job is not to trade. Your job is to trade, maybe, only when you have a risk reward situation that works out. The problem is, it's sort of like telling someone with a mouse in the hand, sit there for 90% of the time and don't do anything. And the people who do that, the click traders who have the patience and the I guess it's the discipline not to trade, but to be able to monitor the markets, 18 hours a day and not trade 90% of the time. Those are the ones that make money. The ones that today, and the ones that trade in groups. If you trade by yourself, you're dead. But the ones that constantly trading, with the edge that they're giving up all the time, with the number of decisions they're making, decisions are based on 4 steps: accumulating data, analyzing, deciding, implementing. It used to be, as a floor trader, you can make that edge all the time and make that process all the time. Then when we came off the floor, there still was an edge, but now it's about it's saying, why am I making this trade? And if you and the ones that I see that are successful are the ones that only trade really when they have their edge. I know a lot of people that sit there for 95% of the day or 95% of the time. They may go days without trading at all, and then maybe in one day they make 10 trades. They may trade 2 days a month. They may trade 40 minutes of a day. They may trade 2 minutes of a day. And the ones that can sit there though and actually do that are the ones that are successful. The one, it's very hard to tell somebody, guess what, you're gonna sit in front of a screen all day and you're not gonna trade, right? Unless there's a real edge. It's sort of like telling a basketball player, okay, you can't shoot a basketball unless it's a perfect shot, right? People aren't trained to do that. But that's really the difference today. The difference is that there are still edges, but that people overtrade, and overtrading today is what we considered severely undertrained before. But if you can wait and have the patience and also have the money to wait, most people also don't have the bankroll to wait it out. But if you can wait and you can monitor the markets and just pick your spots very selectively, I think the click traders still have an edge, a big edge. But it's that they're their own worst enemy. That's what I think, at least. What do I know?
By overtrading, yeah. Well, I just had a question. Like, so, for myself and as well as you and many people that you have cleared for and backed in trading, as I have, making the move from the floor to the screen was very difficult. What percentage of traders made that transition, and what do you think that makeup is to make that transition? And from what I see, on my end, so many very good floor traders just could not trade leaving the floor or feeling the flow or seeing the flow or whatever it is. And I was just wondering your thoughts on that.
I think maybe 10%, 15%, but it's not because there was no edge left. It's because, again, it comes to the same thing. They couldn't stop themselves from trading. On the floor, you had the edge, so you wanted to trade as much as possible. You wanted to trade as much as possible. Where you were the house. Now you're sort of like playing blackjack, where you know how to run a deck, where you got to go ahead and pick your spots, and people have a very hard time adjusting to that.
Well, it's funny. For me, it almost worked differently. So, I started on the floor, and then I was a specialist for spear leads. And what was happening was the product that I was trading was sort of dying, and I became a trader off floor, but trading against potentially guys like you and other people. So in a way, I lost my edge. And then to me, when the screen came on, I was like, oh my God, the tick size in the S&P was a quarter tick wide, and the markets I was getting when I was trading were at least $1 wide. So I looked at it like every time I clicked in, I had an edge because I wasn't giving up 5 boxes or $1.25. So for me, the transition was a home run. But for most of the people that I managed and people from the floor, by losing the edge, whatever that edge was, maybe being able to react to order flow and all of that was now gone, and it was almost dead silent, and they couldn't relate to it. But it's probably what you say as well. They
what you're really saying is you really weren't a floor trader. You were really an off-floor trader on the floor, and then so you developed trading habits and techniques and discipline of an off-floor trader. So when the markets got tighter, it's sort of like your edge got better because the VIG got less.
Right, and then for me, what the greatest part was, and it gave me the ability at that point to size up, was before they would quote the S&P. If it was right now, it's trading at 2867. The market I would get would be 67 at 68. Okay, I'd say buy 50 at 68, and the next thing you know, he goes 69 bid. I'm like, so I couldn't even decide how to size my positions because I didn't know the size that was there, and then I couldn't get an execution because it was very difficult to execute in the pit. And now all of a sudden, I was able to click a button and see size that was bigger size than I had ever seen at a minimum tick increment. And what's amazing, and I mean, other markets aren't like this, crude isn't, but S&P, even in '08, never was really more than minimum tick increment. Might not have had size, but the markets weren't gappy. So, the product became really efficient, and it's great. But what I've noticed, for shorter term traders and whatnot, even guys that were great S&P traders are now trading oil because oil gives you liquidity and movement. So, most days oil is moving 1% to 2% a day. So that's a better trader.
I think you're going to see the energy, and I know this. You're going to see this energy pretty soon. You're going to see the RFQ market come into energy pretty big, where you're going to be able to request a quote, and completely anonymously, and get multiple people to give you a bid offer on two-sided markets on something, and basically block trade, where you'll be able to get a block done without using a broker, just doing it on a screen. So you'll be able to go ahead. Let's say it's crude oil, and let's say you want to buy D7, 19 crude. So you'll be able to say, I'm looking for a two-sided market for 500 D crude, and you're going to see block trades come in, which are basically going to be block trades that drop into the central limit order book, and that's going to be the next evolution in screen trading. Is going to be RFQ trading, and RFQ trading has really taken off in Europe in the equity business, but it hasn't really taken off that much in futures. But I think that's the next step because people want to get done size in a way anonymously with, sort of like the reason why people trade at the end of the day a lot is because they can get a lot of size done on the closing tick. or whatever. And now you can be able to go ahead and get a lot of size done through RFQ in an anonymous process without using an over-the-counter broker, in a much more efficient and less costly way. And I think that's going to be the next big transition in screen trading, at least in energies.
Do you think that'll equate as well in the front month? Do you think people are going to be giving, 400 or 500 up markets on front month crude that I'm watching on my screen now move a dime, on a flash, just move 20 cents in basically 10 seconds. So, I mean, you think you'll see that?
I think you'll see that because I think what's going to happen is, remember, when you do a block trade, okay, it's not dropped in. If you and I were to do a block trade, it doesn't have to get reported for up to 5 minutes. So the only two people that can really know that block trade place is you and I. So if I go ahead and do that, I've got 4.5 minutes before the whole marketplace knows I did that trade.
But who do you think the other side is? Banks? Because I'll tell you, interestingly enough, before 2008, and all the banks getting hammered and consolidating and blowing up, but a big part of our business was we may have had a position in GE, and we'd call up Goldman Sachs and I'd say, hey, give me a two-sided market GE, and they would give me $1 million up GE, 2 cents wide. But basically they were doing it for the commission, but they then they would basically have to run and cover it and move the market. They really didn't have, like, I think it's the same in oil, like the hedge funds have more money to trade with risk capital than anyone else out there.
I think you'll see a lot of market makers will take the other side of the active flow and that stuff. But the beauty is now you can be able to go ahead, like before when you would call up Goldman for GE, and Goldman now, once you bought it from them, when you came back to them, they knew you were going to sell it. Now you could watch if you could do that with the entire marketplace, not just call Goldman. You just go hit an RFQ button. Anyone who's enabled on the screen can do it with you. You don't know who it is. They don't know who you are. And all it is they're trading the size with you.
Yeah. Well, it's interesting, Mike, who works with me, he knows this pretty well, but the CME provides incentive to market makers or firms to create liquidity, and they do it especially in the bond market. And if you look at, they don't do it, on the actual bond, but they're doing it on the option side. And we've seen markets that, are 100,000 up, pretty much a tick wide, and they're algos, so they're able to move and cancel when they need to. But the size is astronomical, and they're actually paying people to put up the size. So.
Right, but the thing about energy that's unique is that in energy you can have 24 months, 36 months of and all different products trading across them, of different combos that trade together. So it's sort of like options, like someone may want DC 18, someone else may want June 18, someone may want a strip of June through DC. I'm trying to say, so it's not like a front month product only. And so basically, I really think the RFQ market is going to take off in terms of energy. I think that's the next big thing that's going to be the next catapult that screen traders are going to adapt to and going to provide a lot of opportunity for, because if you're nimble and if you're willing to trade, especially further back in the curve, right? There's going to be a lot of opportunity, especially because those trades aren't reported instantaneously. There's a 4.5 to 5 minute delay on those trades.
Right.
So we'll see. Who knows?
Oh, that's interesting. Again, as far as managing traders, because obviously in our membership at the Opportunistic Trader, people are always looking for information. What would you say are, for yourself, to manage yourself, because many people are trading at hedge funds or trading for firms or potentially trading alone. What risk management tools do you think are important, or that you use to manage position sizing and capital and all of that?
Again, we stay away from options a lot, because by staying away from options, it's a lot easier to risk manage everybody. And then, for most of my traders, it's really type 1, type 2, type 3. Is this a type 1 trade, ordinary trade? Is it bed ordinary trade? Is it once a blue moon trade? Size your position against that, how that trade is, how much you're going to risk, where you're going to get out. And again, most of the time, you're going to lose on more trades than you're going to make on. But obviously, if you're making a tick and a half on every trade, your net that you're making, and you're losing, 3/4 of a tick or 8/10 of a tick on the ones you're losing, all in, and you can be successful 46, 45% of the time. You're going to make money. Again, but again, I think it's just break. I think it's just being simplistic. I think I think you got to be able to realize when things change. I think you got to trade algorithmically. I think most of the guys now have a programmer working with them also to develop strategies. And I just also think is that things seem to work longer than than people normally do because people like to fade ideas. Like for the last 5 years, buy every dip in the S&P. Okay, this is going to stop, but it hasn't stopped. I mean, it's going to stop, but when it stops, it's going to be for a reason. Or sell gold, which is going on, for the last year because of, I think because of Venezuela. Eventually, that's going to stop. Or buying the dip in energies, or selling Bitcoin. All the everything that every day people come and say, "Well, I'm going to buy Bitcoin today. It can't keep going down." Well, yeah. How low is low? Who knows? How high is high? Who knows?
Right. Right. So understanding that and managing risk around that is important.
And also, it also really comes down to keep it simple, stupid. That's what people don't do. They try to overcomplicate their ideas of how to risk manage, and so you end up getting involved in minutia that means absolutely nothing.
Yeah. Well, for me, like when I look at it, I try to utilize my P&L to, position size, and if we're doing better, we try to be bigger, and if we're not doing as well, we size down and just try to put a P on the page and just try to get positive. But what made it very nice, through the hedge fund and whatnot, was, if we were up a couple percent, we would be able to take a lot more chances. So, the way I look at it is managing P&L to be able to stay in positions or size positions. So I think that's important as well.
All right. I got to run. I've got a busy day.
All right. Thanks, Fish. All right. Have a good day.